So here's the trade setup that we did on this one. This was a very recent trade that we did, and these are all alert trades were sent out. So here was on the 15th, it was trading at 445. So this was the, I need to change that slide. I had the Russell, but this is the SPY. All right, so this was trading at 445. So what we did here, we did this long condor with a max risk there of $75 per spread. All right, so here it is, new SPY short trading at 445, broke below the 21 EMA, testing the 50, next target 442, then down to 439 via vertical put debit spread, the 444, 440 at around $1.15. Then we'll look, and I'll spell this out, we'll look to adjust to a butterfly or a put condor on a move lower. So a lot of times what we'll do is if we break a certain price point, we'll start out with this is what you'll learn in the course. We'll start out with the put debit spread, and then when it breaks, then we'll add the credit spread side to it to reduce our risk and theta. So then we had this next thing. Now it was trading, it broke down. So it was trading at 445, then it broke to 443. So I sent out this alert, said if long that 1844.40 put debit spread, adjust to a long put condor. Sell a vertical put credit spreads at 438, 435 put spread. Fast moving market will follow up with summary. So did that and adjusted this now. So we started with the 440, 440 put debit spread, then added the 438, 434 credit spread to make the condor, reduce our risk to $75, reduce our theta, and still had a great potential profit on less risk. So giving us a bigger return on our capital at risk. So here's what it looked like. Now the chart pattern again, kind of a similar thing. We were down here on a key area of support. So this is a breakdown trade or breakout or breakup, whatever you want to call it. So we're looking at this area here. This is a 50 simple moving average. Our indicators were pointing down. It broke this key support. So we immediately did the put debit spread, ripped down, adjusted this to put condor to reduce risk, to reduce theta, and then took it off here. Okay, so set it up when it was 445, adjusted it, and then now it's trading at 436. So let's take a look at the trade. So here's what it looked like. This is just the profile of the condor. So here it was long the 444 put, short the 440 put debit spread. That was the first side. So you can do this leg it in, leg it out, or you can do it all at once. So this one we actually legged into. And then we're short the 438, 434 credit spread. So after doing that additional leg here, that reduced our cost to $75 per spread with a potential profit, $4 wide spread, 325. All right, so we have total risk 75, potential to make 325, which would be a 433% return. But that's the biggie there. We've got a zero, or we've got a net a credit, not a credit, but a debit of 75. Worst case scenario, we lose $75, or we get out of that. You know, typically what I'll do is maybe a 60% stop out rule, and so you get out, you know, maybe a 30, 40, $50 loss. So here's where it goes out. But it gives us a big, huge profit zone. All of this is profit zone right here, and this is the max profit zone right here. So here it was going out on the 18th, okay? And again, we'll scale out, but here it was on the 18th. So now it was trading at, I need to change that. I don't know where that came in. So it was trading now at, the profit was up, here it is, 209. So it was up, it went from, the spread went from, you know, it was trading at 436.85. And now the spread went from, blew out to 284, less the cost of the trade 75. So it was up $209 on that risk of 75, so 278% return on that. So that was just, you know, a recent trade setup to play the downside, but to keep our risk low. You know, the markets have been trending. See that the other condition on the market, the markets have been a strong uptrend, but we're starting to stall a little bit. So we wanted to keep, the trend was up, but we wanted to keep our risk low in case we were wrong on the trade, on the short trade.